Hello and welcome to the Blue Collar Dollar. I'm your host Tyler, and today we're going to be getting into dollar cost averaging, why it's useful, and why you should be using it. So let's jump into this. Let's say you have $1,000 to invest, and you're looking to buy, specific stock or whatever. The price of it is $14, and you want to get, as much as you can for that amount. So we'll take $1,000 and we'll divide that by the market price. You end up getting, around 71 shares. We're not going to worry about rounding right now. This we'll call method one, full entry. You take all the money you want to invest, you buy it at a one price point, and that is what your cost basis ends up as. Method two is dollar cost averaging. In this scenario, let's say the stock price keeps going down. So we buy at $14 and then it goes to 13, 12, and let's say it stays at 11. All right, now in this scenario you can see that you've still invested $1,000, but you've ended up with over 10 more shares and a lower cost basis. So you have 82 shares as opposed to 71 shares and a cost basis of 1220 as opposed to 14. How that happens is you basically buy at these different points and it averages in, right? So this takes into account all of these cost bases. We'll hit average and we'll just average these out, and you go, well, how does that work? What if I bought some at this point and then this? Well, that's why you invest an equal amount of money, right? If you were to invest an different amount of money or buying different amounts of, let's say $50 here, $100 there, and just buying various share sizes, you're not going to end up with an equally weighted portfolio. And what that simply means is if you had $10 and you bought $9 worth of something and then a dollar worth later, most of your money is going to be located to wherever the price was when you put in $9, right? Because that's 90% of your funds. It's all weighted. Let's say that's 90% of your portfolio. It's all weighted towards whatever the price point was that you invested. So the end of scenario two, dollar cost averaging, we ended up coming out with a little more shares and a little lower cost basis. And what that results in is basically, the results for method one, your cost basis of 14, the current share price of 11, shares owned 71, shares owned 82. This isn't going to change, just the market price. And what that's going to come out to is your current market value right here, right? So in scenario one, your investment, your holdings are only worth $786 now. You put in 1,000, so your unrealized loss right now would be 214. Method two, you put in, the same $1,000. You ended up with 82 shares. Your current market value now, though, is 910, and you're only looking at, a $90 loss right now, which is still under 10%. So you ended up coming out ahead by using dollar cost averaging in this scenario where the stock price is going down. So if you want to buy into a stock and it's going down and you're not sure where the bottom is, you're not sure if it's going to come up, you hear people say average in. Well, this is what people mean when they say average in. So let's go look at what happens when the stock price is going up. So in this scenario, ignore this, the stock price is going to continue going up. All right, so in method one, full entry, we're just YOLOing it. It's $14. We put $1,000 in. We're gonna see what happens. And or you can do the same thing we did last time. You put in $200, every week, and average in. So let's say 14, 15, 16, 17. Let's leave it at 17, right? Now you're looking and going, oh, well, now I only have 63 shares and higher cost basis than if I just put all my money in back here. And you're not wrong. You're entirely right in that. But what you're doing is completely disregarding the variance and risk that this person back here took on, right? So you could be up more or you could be down more. So that comes into your trading strategy. Am I good at picking entries and exits? Or would I rather average in and average out and have a lower downside and maybe a little lower, upside? But, if you are trying to go long in something and you think the stock can go to $30 or something in the next 2 years, then your average here, if it's 1580 or 14, if you think it can go a lot higher, then you don't really care if you're going long, if it's within, a certain amount like this. But if you were doing, we'll get into this scenario on this last page a little more, but if you were investing, instead of every week, over every month or so, you would want to be averaging in, for sure. You wouldn't want to just buy all your money in one position and let it ride out for the rest of the year. Because I know this stock specifically has been at $10 twice in the last year, and over 25, at least another 2 times. So it has a wide range. If you were to come in at the top at 20 and it go to 10, you're down on half your money. So that's not a scenario you want to end up in, especially, like I said in previous videos, if you're not using stop losses, which you should be using stop losses. That goes into the take what you can, give nothing back kind of motto that we use. So in method 1, in the stock scenario where it's going up, you can see that your unrealized profit and loss is $214 gained. Scenario 2, you've gained $82, but you've risked 90 here and 200 up here. And if it continues going higher, you can keep buying in and whatever. You can sell more if it goes down. But the point of this isn't to maximize your gains, right? The point of dollar cost averaging is useful because it helps limit your risk and your downside of spreading out your cost basis average among various price points. And that's useful if you don't have time to be looking at stock charts all day or watching movements, or you're not the best at picking entries and exits, or you don't know what's going on with the Federal Reserve, or if you just want to buy into a position and you want to make sure that you have like a decent price point, then buy it using dollar cost averaging. And you can buy some this month, you can buy some next month, you can buy some the month after. So if the price point keeps moving all over, you can keep getting, a decent average in your position. An easier way to do this might to be just buy every time it touches the 200-day moving average. But again, what if it just keeps cratering and the 200-day moving average keeps coming down and down and down? Well, at some point you need to limit, obviously in investments if you're just throwing money in a hole. But averaging in is a lot easier to do once you start doing it. Let's say you get your paycheck every 2 weeks. You put $50 into one stock every 2 weeks. A lot of people are already doing this. And this is what you're doing, without even knowing it. But this is the math behind it and how it helps limit downside and why it's useful. So the last part here is, let's say that's a choppy market, right? Or even not just a choppy market. Let's say it's over a long time span. And, this note that I've thrown in here, useful when depositing it into retirement accounts. Let's say you get a yearly bonus or something and you want to put it all, $25K in or whatever, and max your funding for your 401k out all at once. Or your Roth, you put in your $6,000 or whatever. Whatever you're maxing out, let's say you put all your money in, you get your income tax return, whatever, and you go, I want to invest all this money. Definitely should consider using dollar cost averaging in that scenario. Okay, this isn't financial advice. This is purely educational math, but this is why your textbooks, teach this, is because, let's say in this scenario, you put in $14 up here, and you ended up with the same 71 shares. Now, Let's spread this out over a longer time span, right? Because it'll make a little more sense. And you won't, stocks don't usually move crazily over um, a week or two. I mean, they can, but besides the point. Let's say 5/1, 2022, and we'll just drag all this down. So let's say in April it's $14, and in May it's $10 because it is $10 right now, and it was 14 in April. In June, let's say it goes to 9. Into the summer, let's say the supply issues start clearing up with batteries and manufacturers in China and Foxconn factories start opening and whatever, right? They've got an SUV coming. Let's say the stock price reverses and starts going back up. So let's say we go to 9. Let's say we're back to 14, and then coming into the end, let's say we go to 20, right? So again, in this scenario, instead of dumping all my tax money in and getting 71 shares, and then 2 months later being down 50% on my position and going, my wife's gonna leave me, like everything's looking dark outside. You don't got to worry about that. You're averaging in this position. And some people use this as a cop out for like, oh, you're just buying more of a losing investment. Always have a plan. Always trade, your plan. If anything fundamentally changes, if there's a break in your investment thesis, then you should, have some discipline and get away. There was a guy who just took a $400 million L on Netflix stock because they had earnings come out and they basically gave guidance on the company that went against his investment thesis. And instead of sticking out for, $1 billion loss, he goes, look, I know I'm down money, but the reason I was here invested is gone now, so I'm gone with it. All right, so in this scenario, let's say price keeps going back up. Now you've came out ahead with, 9 more shares and the lower cost average. And again, you came out ahead with a little more profit. Yeah, it's funny. So, yeah, if the stock continues to just beeline straight up and you're averaging in, obviously you're going to have less shares and obviously you're going to have less profit loss. But what you want to look at here is your risk levels and everything, right? And your skill level at picking entries and exits. Because if you go to a chart and you can't determine, historically you're keeping a trade journal and you're looking at all your investments and you're just picking bad entries, start looking into dollar cost averaging. And this can even go, as simple as a shorter time span as day trading. Like let's say I buy a couple shares in the morning, a couple shares in the afternoon, a couple shares in the, whatever, and then I sell them all. You can average in, you can average out. You don't have to throw all your money in. It's not like a casino. If you're playing poker, you don't just go all in on every hand. If you have a good hand, you can throw a little more in. If you got a losing hand, you can tap out. It's basically all this is it's managing risk levels while averaging into positions. I hope this video helped. If it did, hit the like button, drop me a subscribe. Be really useful. Thank you. Have a good day.